This welcome to Pineapple Support, and this is our money and mental health in the adult industry event. Thank you ever so much for everybody for joining us, by the way, today. It's very, very much appreciated. I just want to tell you a little bit about Pineapple Support. So we are a non-profit organization. We are specifically providing mental health resources for those in the adult industry. So if you would like to help support us, because Pineapple Support is completely donation led. So please, if you can, head over to the website, which is pineapplesupport.org, or you can go to our Instagram, which is pineapple_YSW. Now, you can go there and you can donate, but you can also check out the resources, the workshops, all of our events, and also if you're looking for some support for yourselves. Now, also, I want you to also make sure you check out the cream pie challenge. I've already done this myself. You have to take part. It is fun. Please do it. And it is, you're creaming literally for a cause. Now, over the next 2 days, we are going to be presenting topics on money and on mental health in the adult industry. So today, I would like to welcome both Nate Mallory and Mia Lee, who will be discussing from content creation to retirement. So I'm going to hand you guys over and make sure you all take notes.
Hi, everyone. Shar, thank you so much for the lovely introduction. I'm Mia Lee.
And I'm Nate Mallory.
So today we're going to talk about, I guess I could call it financial adulting and some of the considerations that are really important for us as adult creators to secure our financial futures, to relieve financial anxiety, and essentially do all of the mentally and emotionally healthy things from a financial standpoint that many of us should be doing or need to start doing or maybe have already been doing.
So to just kind of go over briefly, me as my background, I'm a tax attorney that has been working in the adult industry with my law firm, Only Tax Deductions. I specialized in tax law and wealth management, and also became a certified financial therapist, taking kind of a holistic approach on finances and not just a money-based approach to helping people with their retirement goals.
Hi, I'm Mia. I have been in the adult industry and am currently active in the adult industry. No plans on retiring anytime soon. I've been Mia for about 7 years and counting now. Prior to being Mia, I worked on Wall Street for some of the top consulting firms for about 12 years. So my background is as a forensic accountant. So I am a CPA, although I've never done taxes as my profession before this company. So I'm also licensed as a registered investment advisor. And Nate and I unofficially are announcing on this video presentation that we are merging our companies into a new entity called Floor Play Financial. We will be issuing press releases through XBiz AVN and social media, all of that, after the contracts are all signed. But essentially, we are in the process of merging my investment firm and Nate's tax practice into Floor Play Financial, sort of like all of your tax, financial, and legal needs as an adult industry professional all on one floor to help you build your business from the floor up. We're still working on the puns, bear with us. But in any event, Nate and I are, this presentation was created sort of before. Thank you so much, Zanine. I'm so sorry if I said that wrong. But yeah, we made this presentation before we chose our new company name. So the bios are still written as if our companies are separate. But just FYI, by the time this recording is released, probably our new entity will have been formed and announced. As an adult creator, I saw firsthand some of the challenges and financial trauma and discrimination and all of that my colleagues faced in the industry. And so Nate and I created our new company in order to address and alleviate some of those things.
So today's topic specifically, we're going to talk about retirement planning and wealth management for people in the adult space, whether that's in-person work or online work, OnlyFans, escorting, dominatrix work. Um, any niche within the adult industry, there's going to be a similar basis that everyone is starting at, and that's that you're all entrepreneurs. At the end of the day, your business, your brand, your stage name is a company, and with that comes with some unique challenges for retirement planning, but also some unique benefits. So one of the things that me and I always like to talk about when discussing retirement planning is longevity of career. And what we like to kind of, get in the back of people's minds when thinking about the adult industry is that it's not a traditional workspace or work environment. And the typical retirement idea of working until 65 is, possibly not realistic for people in the industry or just not desired. So on this chart, there's a comparison of what the average longevity for certain professional athletes are, which kind of lines up a little bit better with a lot of the work in the adult space. The barrier to entry might be kind of high, but the ability to earn a considerable amount of money is also high. But how long you're going to continue making that kind of money or working in the space altogether is, usually considerably less than traditional careers. So, comparatively to U.S. football is an average of 3 years, and boxing 16 years. Still significantly different than traditional W-2 employee that might work 40 years, even within the same company.
So
Um,
I like, sorry, go ahead, Nate.
no, no, go ahead, Mia.
Um, so I just want to caveat that by saying we're not giving this problematic speech that, you're going to age out of the industry or anything like that. It's more from the perspective of this industry. I like to call it fast money, not easy money. So that presents its own benefits and challenges. And also because of so many reasons, including but not limited to the stigma that we face, a lot of us either have to retire at a certain point in order to pursue other careers or family, or we want to retire at a certain point for all kinds of reasons, myself included, right? Like I thought that I was going to be a forensic accountant forever until retirement, right? And I ended up getting sick, and then I transitioned into the adult industry, and I was like, "Oh, I love this. I'm going to be an adult creator forever as well." And then I met someone and became a stepmom, and now I'm like, "Well, okay, maybe forever is going to turn into 10 or 15 years instead of 40 years because as much as I love this industry and I'm not afraid of the stigma, I am considering my stepchildren and I don't want them to be bullied because of my job, right? So there are so many reasons that many of us might not have a traditional 40-year career span. Also, adding to that, I think generationally, so I'm a millennial, and I think that like boomers, some of our parents' generation, they had a very traditional career trajectory, right? It's like work 40, 50 years, retire at 65, play golf with all of your retired friends. And I think many of us, independent of adult entertainment as our careers, just have a very we have a much more fluid view of retirement and financial planning, meaning some of us will burn really hard for a few years and then maybe take 2 years off and then come back to work. Some of us might be utilizing our adult industry earnings to fund, let's say, law school or medical school, and then we want to focus on that career. So it's just something that, from a financial planning and tax planning standpoint, Nate and I think about for our clients when advising them on how to manage their money. And for many of our clients, they are. Um, they are on this trajectory to work for, let's say, under 10 years, and then they want or need that money to last for essentially the rest of their lives. And because of the high earning potential in this industry, for many of our clients, that's possible, but it requires a different type of planning and different recommendations from the tax and planning and financial advice side in order to make that happen.
And one of the things we'll talk about in this presentation is the benefit of compound interest and having time on your side of investments in the market. And even though the adult industry might have a shorter career longevity, one of the unique things that's happened over the several decades is that the average age that workers are starting in the industry is getting younger and younger. Back in the 1970s, it was 29. By the time this study came out in 2013, the average age is lowered down to 24. And since 2020, with the incredible increase with OnlyFans and other platforms like that, the average age for sex workers starting their profession has gotten even younger. And one of the benefits to that from a retirement standpoint is the sooner you can start investing into your retirement plan. And Mia's going to go over kind of those processes and options to do so. The quicker your money is going to start compounding and be able to grow to reach your retirement goals. So one of the questions that we ask very often is, how much do I need to retire? And there's all sorts of kind of wives' tales of, rules of thumb that might have worked back in our parents' day, but unfortunately with inflation and the changing times and changing administrations, $1 million is not necessarily enough to retire like it used to be, 10, 20 years ago. And really, there's a general rule of thumb that I like to use called the 25 times rule, or also the 4% safe withdrawal rate, or SWR. And what that is the amount of money that you need to retire to sustain the lifestyle that you currently have is you need to set aside 25 times of your annual expenses. So that's how much money you spend on your rent or mortgage, insurance, medical expenses, food, leisurely activities, travel, all of that calculated together. If you have 25 times that annual expense, based on how long you live and what age you retire and a few other factors, that's the general golden rule that you'll have enough to retire. That same math works out to what's called a 4% safe withdrawal rate, which what that means is if you take 4% draw every year from your nest egg, from your retirement account, so if you had $1 million, that would be $40,000 a year. That at that 4%, with inflation calculated into it, you won't run out of money by the time that you transpire. And again, factors come into play of how long are you going to be retired for? What's your life expectancy, things like that. But this at least gives you a general rule of thumb to kind of gauge and track your progress off of. So one of the big differences with being in the adult industry and retirement planning is you don't have a government pension or company pension to rely on. You don't have a 401k with an employer match that you can just set aside and assume, okay, if I work the next 30 years at this company, I'll be okay. You're really left all on your own as far as your retirement's concerned. But with that, there's a few vehicles available uniquely to self-employed individuals and business owners that have benefits that outweigh some of those benefits from a 401k or even a match program with an employer. Some of those that we're going to talk about are going to be a SEP IRA as well as a solo 401k. So these types of investment vehicles are broken down into three categories as far as taxes are concerned. So you have what's called a taxable account, which would be a brokerage account. If you open an account at Mia's firm or E-Trade or Merrill Lynch, Wells Fargo, any institution that does financial planning, a brokerage account, you pay your taxes on the income you've made beforehand. You put the money into a brokerage account. You invest in stocks, mutual funds, index funds. And then in retirement, you're going to be paying taxes on the growth of those assets. Compared to there's tax deferred accounts, which the most common being a 401k. Those work by having your taxes paid in retirement and they're deferred when you make the investments. So at a traditional job, you would have your contribution to your 401k taken from your paycheck prior to your taxes being paid or taken out. And then in retirement is when you would pay those taxes. And then inverse to that is your tax exempt, or some people call it tax free. I like using exempt accounts. And the most common of that would be a Roth IRA. And that works the opposite for a 401k. You pay taxes on the money now when you earn it. And then the money that you pull from those accounts during retirement are going to be tax free. Now, the trade-off to this is you're essentially trying to decide if you think you're going to pay more taxes in retirement than you pay currently, in which case having a Roth IRA would be beneficial, or if you think tax rates are going to be higher in retirement for you than what they are now, in which case the 401k would be beneficial. And really, it's a bit of a guess. There's plenty of dispute among the financial literacy out there on whether tax rates are going to keep going up. And every time there's an administration change, it feels like our tax code is constantly being changed, or at least trying to be changed. But historically, even though taxes seem really high here in the United States, they've been significantly higher. Our historic tax rate's been as high as 90% for federal income tax, compared to a 37% bracket now. So there's definitely room for taxes to go up, and historically they don't go down considerably, but we are kind of in a lower point as far as the timeline of taxes in this country. And talking about compound interest, which Mia will get more into on the specific types of investments, goes to that benefit of the earlier you start investing, the more time you have for your investments to compound on top of each other. That is, as they gain value, then that value gains value, and now you're making accrued interest on top of the gains that you're regularly making in those investments.
So this is a neat, I guess, shortcut to calculating compound interest. It's called the Rule of 72, and it basically answers the question, how much can you earn over time with an investment of $10,000? So we walk through a few examples here. So basically, the idea is that your investment will double every 72 years for every 1% of return that portfolio earns. Meaning, if you invest $10,000 and your portfolio is generating 1%, say in a savings account, right, in interest, then your $10,000 will double to $20,000 within 72 years. So if you have a portfolio that's earning 4%, then it's going to double every 18 years. So the $10,000 example, let's say you invested at age 29. By age 47, you'll have $20,000. By age 65, you will have $40,000. So Carrie said, yes, hopefully if you earn and not lose, no investments are secured. That is accurate, and that's a really good point. So um, a lot of the investments that we place our clients' funds in are not secured. And all of that really depends on your risk tolerance, which we'll talk about a little more later. But one of the things that I get asked a lot by clients is, can you recommend low risk, high return investments? And my response, unfortunately, is the truth is that is an oxymoron and it doesn't exist. You cannot have high return and low risk. Risk and return are positively correlated. So if you are uncomfortable with taking on a lot of risk, then I would advise as a potential client for you to invest in safer vehicles that are going to have a lower return, like government bonds or something like that, right? So moving further down to the example, so the S&P 500, which is a stock index of the 500 largest companies by market capitalization in the United States, the S&P 500 has historically returned 10.62% annually, going back, I think, about 30 or 40 years. So that means that if you invested $10,000 in the S&P 40 years ago, it would have earned you 10.62% over that 40 years. Now, would you earn 10.62% every single year? Absolutely not. You might have not earned 10.62%, that average number in any of those years, right? You're going to be up 12%, down 5%, up 6%, down 1%, et cetera, et cetera. But over that time, if you left the money and didn't touch it in the S&P 500, you would have earned and compounded an average of 10.62% a year. Now, that requires discipline, right? So it's like one of the reasons I tell my clients not to pick individual stocks and not to try to self-invest and time the market is because people are prone to, one, thinking that they know more than they actually know, and two, making emotional investment decisions. So it's like the market goes down, you pull all your money out, and then you sell at the bottom. So, Carrie, I'm so sorry to hear that that happened to you, and very happy to answer any questions or talk about that later on in the presentation or now if you want to talk about that now. Um, so one of the reasons that we really, really push our clients and listeners to our podcast and everyone that I speak to, especially in the adult industry, but certainly not exclusive to the adult industry, to do is to invest early because then your money can start compounding early. And one of the things I really caution against, especially for my colleagues in the industry who do in-person work and earn cash, is not to leave your money under your mattress because the money sitting under your mattress it is inflating away every year. So I had a client who had $157,000 sitting in cash in a safe. And the problem with that is that, well, there are many problems with that, their security aside, but that $157,000 is worth less every single day, every month, and every year, and it's not earning anything for her. So um, inflation never sleeps. Like we've all heard the term money never sleeps. Well, neither does inflation. So US consumer prices have risen about 3.2% a year on average since 1913. Um, so that really halves your purchasing power every 22 years. So um, in terms of closing the retirement gap, the median balance for Americans in their 50s is only about $250,000 versus 1 to 1.5 million that most of those Americans should have, or we would suggest that our clients have for a middle class retirement. So we have a few investment strategies that we advise most people to partake in. Um, and it's not going to fit every single person, but one of the most common ones is dollar cost averaging, right? So that's a method of systematic investing that prevents you from making emotional decisions and selling at the bottom and trying to time the market. So dollar cost averaging is where you basically set an amount that you're going to invest at an interval of time. Let's say it's every week, every 2 weeks, every month, every 6 months, and you essentially just put that amount into your specified investments at those time intervals, regardless of where the market is and where your stock portfolio is. And that way, you're essentially buying more when prices are lower and you're buying less when prices are higher. So in addition to retirement planning, I also lump in these financial goals, right? So whether you want to pay for college for yourself or a dependent, whether you want to purchase a home, whether you want to have a nest egg saved and use that for entrepreneurship or early retirement, all of these financial goals require an amount of capital or a nest egg. And you're going to want to account for inflation when accumulating that number. So these are the basic asset classes. So most of us, when we think of investments, we only think of equities or stocks. But there are also other asset classes, right? So stocks, just an experiment. I am Egyptian, and in Egyptian currency, 1 pound means 26,000 pounds. Oh, very interesting. Thank you for sharing that. Um, so we typically advise our clients to hold a mix of equities, which are stocks or index funds, and bonds, which are can be corporate bonds, can be government bonds, can be municipal bonds, and then cash or cash equivalents. So cash is just cash, right? But cash equivalents can be things like certificates of deposit or treasury bills or high yield savings account. We consider those cash or cash equivalents. They're going to yield very little. But they are incredibly secure and you're not going to lose your money. Other asset classes are things like real estate or private investments. And I'm going to talk a little bit more about those later on. But one of the most common mistakes that I have seen my colleagues make is over investing in private investments, including but not limited to real estate. And my take on this as an investment advisor is that you really should not be holding more than maybe, I don't know, 5 or 10%, 15 at the most of your investments in private investments, including real estate, unless you have specialist knowledge of those investments. Like for instance, my primary partner used to be a private equity healthcare investor, and now he runs his own healthcare company as a CEO and founder. So, of course, more than 15% of his net worth is in his company, but that's different because he has a specialized knowledge as his primary profession, and that's his job, right? Whereas I have some private investment holdings. Like I have a non-controlling interest in an alternative mortgage company based in Kentucky. I had a coffee farm in Colombia for a little bit. And all of these investments are no more than 10% of my entire net worth. The majority of my retirement savings, short-term financial savings goals are invested in public equities and corporate and government bonds because that is a non that's a non-private investment that has a lot of liquidity. And that's just more appropriate for my situation, my financial goals, and also the situation's financial goals of all of our clients.
And me, I think maybe to kind of, recap again, you're a registered investment advisor, have your own investment firm, and you still don't try to beat the market yourself, at least on a regular basis. And I think most people would say your investments and mine too are kind of boring sounding compared to, cryptocurrency and real estate investments and things like that. Is there a reason why you don't have more colorful investments?
Yeah, it's a great question, Nate. So, real quick, I just want to answer Carrie's question because I have gotten this feedback a lot that I talk too fast and I'm working on it. So thank you for telling me. Carrie's question was corporate and what bonds? That was corporate and government bonds. Okay, so the reason why I do not pick individual stocks, even though I'm a registered investment advisor, I spent 12 years on Wall Street, is because there are large institutional investors, so think hedge funds and pension funds, and they're what we call market makers, meaning they move so much money that their trades influence the prices of certain assets, whether they be stocks or bonds. And these market makers, like, so think of, let's say, BlackRock, right? That's a big hedge fund. Um, they have entire teams of PhDs with like doctorates in pharmaceuticals and geoengineering or whatever these things are, plus financial professionals, plus quantum computers, plus all of these assets that an ordinary person wouldn't have, and even I as a financial we as a financial institution don't have, right? And the purpose that of having all these expensive talent and assets is for these hedge funds to be able to calculate with better accuracy than an ordinary person or a smaller company what is the actual right price for certain assets like stocks and bonds, right? And so when the rest of us mere mortals are paying for, are acquiring an asset, we don't have that information. And as smart as I am, as confident as I am in my abilities, the abilities of my team, we are not going to outprice, outpredict, and outperform the hedge funds of the world that have billions of dollars in assets under management and all of these resources that we simply don't have. So even for our clients, we're not picking individual stocks and we're not trying to time the market. What we are doing is giving our clients, and I have money invested in as a client of my own investment company, so I have skin in the game with you guys. Um, what we are doing is giving our clients risk appropriate exposure to their appropriate asset classes, meaning like, so if we have a client that wants to make more money and is willing to take on a little bit more risk, we're going to invest their money in a higher mix of stocks versus bonds because, as I mentioned before, risk and return are positively correlated. So from an asset class and asset allocation standpoint, stocks, generally speaking, are going to be the highest risk and give you the highest return. Next will be corporate bonds, which will give you less risk, but also a lower return than stocks, but they're going to give you a higher return than government bonds, right? Which are even lower return, but much lower risk. And then the least risky thing is going to be cash equivalents. So those are things like CDs or certificates of deposit or high yield savings accounts where your funds up to $250,000 are insured by the FDIC. Um, so yeah, basically, I don't pick individual stocks. I don't advise my clients pick individual stocks. And look, for every Redditor who got lucky buying GameStop or some meme stock at the right time and selling at the right time, there are probably 50 bros who lost their entire life savings. And I think that if you really think that you are so smart and you have read so many finance books that you can outperform the hedge funds of the world, I don't know, maybe go work for one, right? It's just not realistic. Okay, so did we talk about compounding through indices? Um, okay, I think I we can probably skip this one because I think I kind of talked about it a little earlier. Um, so risk versus reward. So basically, this is the question that we ask our clients, and we have this investor questionnaire that we use to financially get to know our clients and what they're comfortable with. So it's really the goal of investment management for us, at least, is to understand our clients' willingness and ability to lose some or all of their investment in exchange for the potential of a greater return in the long term. So obviously, we all know crashes happen. So one of the worst calendar years was 2008, the subprime mortgage crisis, at least in our lifetimes. There were other steep declines historically before many of us were born. And so 1974, market was down 30%. 2022, market was down 18%. Um, and like this is a chart. I have another iteration of this on the Mealy Financial Twitter feed where it has like photographs of events that have happened throughout history. So like if we this one only goes back to 2008, but I think the one on my social media goes all the way back to like the Great Depression, but the trend line is very similar. So you see these little dips here, right? And um because we have a relatively myopic vision of the stock market, um we really think that a crash, like one of these crashes, is sort of like the biggest thing that's ever happened, is the end of the world. It's kind of like when you're 16 and you think that you'll never fall in love again when you get your heart broken, right? It's the same thing with investing. So if you're not an economist and oh, thank you so much, KJ Hunter. So if you don't have a long-term historical view of financial markets, then it's really easy and understandable to think that, say, the COVID crash is the worst thing that's ever happened. And in reality, it's not, right? So there are professional investors and traders that survived, kept their jobs through things like the Great Depression, the subprime mortgage crisis, the COVID crash. And when you look at a bigger picture, right, this is only since 2008, but the trend line is very similar if you go further back. So my point here is that if you left your money invested, right, like let's look at the COVID dip because that was the most salient one, right, in our lifetimes, and it's very recent. Like, yes, this was a meaningful drop, but if you didn't sell at the bottom, you left your money invested, you didn't do anything and just held a strong stomach essentially, the market was back to all-time highs in under 6 months, right? So this is something that we manage for our clients. You are obviously, everyone is capable of doing this for themselves, because we also appreciate that not everybody is in a financial position to be a client of our firm or any other financial advisor. But I show this to people because our clients often ask us like, hey, is this a good time to get into the market? Is this a good time for me to buy NVIDIA stock? And my answer is time in the market beats timing the market, meaning the earlier you start, the longer money stays invested, and the longer you stick to a level of investment discipline, um, the better off you will be in the long term. Okay, we kept this relatively short because we figured people would have questions. So throw your questions at us.
And KJ is a great movie. I've seen it several times, so and we appreciate the kind words.
Yeah, I also watched the movie. And I guess like I've had a lot of people ask me what I did in finance, and I always ask back like how familiar you are with finance. And if you're not very familiar with finance, so my old job in finance, if you've seen the movie Pretty Woman, I had Richard Gere's job.
Which actually, our last webinar, we had quite a few people that had not seen Pretty Woman.
I
So
know, I was shocked. We did a focus group with some in-person sex workers, and I was trying to explain my old job on Wall Street, and they were like, "I've never seen Pretty Woman," and I was like, "Oh, I got to come up with a new analogy." Okay,
what's the difference?
Carrie asks, "What's the difference between corporate bonds and government bonds?" Okay, great question. So, an example of a corporate bond would be something like um, IBM doing a bond issuance, and they're trying to raise money by issuing debt to fund private investments or to fund, it's not private. So large companies usually have a debt offering because they don't want to give out more equity, meaning they don't want to give out more shares of their company, but they want to raise money to do something with it. And so corporate bonds are typically issued in denominations of $1,000, and that's what's called the par value. But when you buy, say, an IBM bond at issuance, it's typically priced either above that or below that, and that's called a premium or a discount. So that premium or a discount is calculated based on the investor's perceived risk of lending to that company. So in the case of a company like IBM, that's investment grade, and investors typically consider it very safe to lend to a company like IBM. So you're typically not going to have a very high yield because, again, risk and return are positively correlated. So, because investment grade or AAA rated corporate bonds are considered very safe, they're going to earn you a lower return. Now, compare that to something like a junk bond, right? So, think of Hertz before they went bankrupt or during the bankruptcy. So, their debt was trading at a significant discount, and that was going to give you a much higher yield because the company's in bankruptcy. It's very risky to lend to them. So, those are examples of corporate bonds. And then you have government bonds. So government bonds, at least domestic government bonds, and you can buy foreign government bonds, but that's like a little more detail than I want to get into right now. So government bonds, I split into federal government bonds and municipal bonds. So federal government bonds are bonds issued by the U.S. federal government. And they work a lot like corporate bonds, but they typically yield much lower, meaning you earn less on them because the US government has never defaulted on its debt, compared to, say, a country like Argentina, which has defaulted on its debt. So government bonds are typically considered by investors to be safer than corporate bonds because even though IBM is a large liquid company, the chances that IBM will go bankrupt are higher than the US government going bankrupt, right? So those are examples. That's an example of federal bonds or like what we call treasury bonds, because they're issued by the United States Treasury. And the Treasury also issues, so they issue bonds, which are the longest date to maturity, meaning that I think some of them are like, they're all over 10 years. So some of them are like 20 years, 30 years, 50 years. And then they have government notes, which are shorter in duration, under 10 years. And then they have treasury bills, which are very, very short term and they're considered cash equivalents and they yield like basically inflation. Um, and then you have municipal bonds, which are really interesting to me because if you're in a higher tax bracket, municipal bonds are the interest from municipal bonds are always exempt from federal taxes. And if you buy municipal bonds or an index fund holding municipal bonds in the state that you live in, they are also exempt from state taxes. So, for instance, I hold a portfolio of New York municipal bonds. I'm in a very high tax bracket, and the interest from those bonds is exempt from both federal and state taxes. So municipal bonds are typically they're issued by cities, states, counties, municipalities, and they are typically considered higher in risk than federal government bonds. So for instance, like Detroit, Michigan went bankrupt as a municipality, but it's not very common. So municipal bonds are considered higher risk and they're going to earn you a higher return than federal bonds issued by the Treasury, but they're going to earn you less money than corporate bonds because, again, like New York State is less likely to go bankrupt than IBM, generally speaking, right? Um, so does that answer your question about bonds?
And if you follow up on it, we touched back to it. Let's go to the next question. How much do people set aside before contacting you about your services? Mia, correct me if I'm wrong, but we don't have a minimum required investment for people to invest with the firm. But really, it's
So
the
it's actually $1,000. Sorry.
oh, I'm sorry, that's okay. I knew it was at least really low or not.
It's very, very low. Yeah, it's so it's $1,000 and we set it that low um at our own cost because we wanted to make our services as accessible as possible to the industry, and that was very important to us. And our fees are also very, very low compared to other investment advisors, which means it's going to take us longer to be a profitable company. But that was also very important to me. I'm a very firm believer that if my team and I are that smart, then we can deliver you top-notch Wall Street services for a fraction of the price. So my chief investment officer is a gentleman who was managing a $40 billion portfolio for Nuveen Investments prior to his retirement when Nuveen was taken private by a private equity fund. And so he retired with like a couple hundred mil and he doesn't have to work anymore, but he thought that this company and this investment firm serving this underserved population of adult entertainment professionals was both exciting and will be profitable once we scale. So this was like his pet project. And like, so the level of investment services that you're getting are something that um, people typically in our income bracket would not have access to, except that our chief investment officer and my co-founder, my chief operating officer, are very good friends of mine from my Wall Street days. And we thought that this would just be a cool project and hopefully a profitable company in the future for us.
And now in addition to the investment service, our company also has legal tax services as well. So even if you don't have, the money to start investing now, there's other services that might be helpful, or at least educational material that might help you create that financial plan. I've been watching Diary of CEO and some of the podcasts. I've learned that most millionaires are made from consistently putting money into a stock folder and waiting until retirement. I think I got that right, but I'm not sure. Yeah, so there's been plenty of studies that have been done on millionaires in the U.S. I personally love the Millionaire Next Door book. I think it was written in the 80s by a PhD economist and I believe a finance PhD student as well. And shows trends on millionaires in the U.S. Everything from what kind of car do they drive to what kind of profession are they in. And there's always two large groups that are, I guess, three common groups for millionaires. You have the ones that already came from money, the ones that are entrepreneurial, start their own business, usually several businesses. There's a lot of statistics on entrepreneurs and what the success rate is, and depending on industry too, restaurants being notoriously really low success rate. And then there's people that work their entire career as an employee for someone else's company, and they're just smart with investments and they're setting money aside, and that's a path to becoming a millionaire as well. What is the best starter app to start investing with? I've heard Robinhood, Fidelity. So obviously, working with us is one option, but there's plenty of other financial institutions out there. Each of them have different fee structures. Robinhood got a lot of notoriety for being one of the first platforms to be kind of targeted towards the younger generation and to eliminate a lot of the stock trading fees. I think a lot of financial institutions have kind of followed suit in that and at least reducing fees over the last 10 years or so. Up to you how you feel about how Robinhood acted during the GameStop bubble and the support they had for some of the kind of larger institutions there. But at the end of the day, it's there's dozens of options for opening an investment account with different institutions. Things to consider are ease of use, whether you want someone in person that you can talk to, or if just using an app is enough. And then fee structures. What does it cost you to invest with that company? What percentages are they taking? It's very important to be familiar with what's your cost going to be. And that's when Mia started up her firm and saying those fees really low. Part of that was having the transparency of here's our cost and our total cost. Some institutions are better about doing that than others.
So I typically recommend to individuals in this profession who have low financial literacy and who can't afford our services, Vanguard, because Vanguard has extremely low fees. They're so low that in the financial services industry, we joke that Vanguard works pro bono. And basically, it's just because they have so much scale that they can make money on very low fees. So I typically recommend Vanguard. I always recommend index funds because they're passively managed. Um, and I didn't realize I was on mute before. I wanted to loop back to the millionaire question. It's not a secret. Like I gave my tax return to the Washington Post when they did a feature on me about sex worker taxes. So I'm a millionaire. I came from absolutely nothing. Like I was a Chinese political refugee. I grew up in foster care. 20 something years ago, I was sleeping on a bunk bed in a homeless shelter with a bunch of other foster kids. And like I have a nice home in Manhattan. I drive a Mazda Miata. Like it's not a fancy car. Um, I live like very far below my means and I put away money every month. And in finance, we have something called a fuck you number. And that's basically a nest egg that we consider sufficient that we never have to work again. And so for me, my financial security is much more important than buying designer bags or having a flashy car or anything like that. I mean, really, the only thing that I think I've really splurged on is my two-bedroom apartment in Manhattan. And that was just a priority for me to have this space, especially when I was doing in-calls. Um, so yeah, that was like profile of a millionaire. Like you don't I think there's something that I like to call quiet wealth. And a lot of my friends and I who have millions of dollars, like we're pretty quiet about our consumption. Like I think if you hadn't read the feature of me in the Washington Post, a lot of my friends would not know that I'm a millionaire. And I think it's something to keep in mind, especially as we project an image of wealth and luxury for our professions, not all, but a lot of us. Um, you don't need to buy a real pair of Louboutin shoes to shoot in them. Just saying.
I want to start investing, but I don't know how or where to invest. No idea how to get into the market, and also to decide where to invest without lots of financial knowledge. We talked a little bit about where you can invest in different financial institutions. Obviously, we would love to have you as a client, but there's other options. As far as financial knowledge, just absorbing as much information as you can. Me and I actually are launching a new podcast that's coming out next month called Dirty Money, Clean Books. We talk about a variety of topics from qualifying for a mortgage for a house to investment strategies to myths about money. But there's plenty of other podcasts and other educational resources out there too. Personally, I'm a big fan of finance books. I mentioned Millionaire Next Door. Another one I'm a big fan of is called the Three Fund Portfolio. It's a very passive investment strategy, stems from Jack Bogle, who's the founder of Vanguard, which obviously is a massive financial institution here in the US.
They're
And
not
really,
paying us to say this, by the way. I recommend Vanguard with no incentive to do so.
they can't. We've seen their fees. They don't make enough money to pay
Oh
anyone
no, they make so much money because of
on
their scale.
a scale. But a lot of my investments are in there for exactly that reason. Vanguard Admiral
Mine too.
shares 0.04% management fee, which is, I mean, basically nothing. So yeah, reading books, listening to podcasts, asking questions. But at a certain point, it's just kind of getting your feet in the water, once you feel comfortable enough, and, just don't stretch outside your comfort zone. If you feel like you know what you're doing, go ahead and, start doing some investing. Or if you're still kind of learning the ropes, either do it passively with index funds or, go through a financial advisor.
Nate,
Uh,
what is our pricing for tax services?
Oh, okay. So yeah, tax services. When it comes to tax returns, we do everything on a flat rate price based on the forms that are filed. Part of what we try to do to be as transparent as possible. I'm an attorney. I hate attorneys' fees and how you never know what to expect. And so when I started my company, that was one of the big things I want to focus on was transparency and cost. So we do it based on forms. A schedule or a form 1040, which is the individual taxpayer form, I believe is $500. Having a schedule C, which is going to be needed if you're self-employed or have a single member LLC, is 300. State returns are $100 on that. And then, if you have more complexities to your taxes, rental properties, certain investments at profit and loss, or if you have a C corporation, S corporation, partnership return, things like that, those forms have separate costs as well.
We had a question, do you help UK clients? No, unfortunately, Nate and I are only licensed in the US, so we can only take US clients.
Yeah, or at least putting money in U.S. assets. So I mean, to give an example, like I have a couple clients that are European-based companies in the industry, but they have a U.S.-based either subsidiary or an asset that they're having either taxes through or investments through. But short answer is yes, it has to be U.S. based. Um,
When someone
Rental.
receives a settlement, oh, I'm sorry, go ahead, Nate.
Oh, which I keep in mind when investing in rentals. I'm in Nevada. That helps.
Okay, so I'll take that one. So investing in rentals in Nevada, I lump investing in rentals in with private investments, meaning illiquid. And they're outside of the three asset classes that we deal with in our financial firm. So I would go with the same rule, no more than 10% of your total net worth, and understand that it's illiquid, understand that private investments, like what private equity funds invest in, are significantly higher risk than index funds or public securities. And like when you make a private investment, you have to do the diligence all yourself. So like when I put $50,000 into an alternative mortgage company as a private investment, like I had to do all of that diligence myself. I read the investment decks, I diligenced the founders, I diligenced the management team. It's a pretty intensive process. So if you, one, could not afford to lose every penny that you put into that investment, or doing so would put you in a really bad spot or make you very uncomfortable, don't do it. If the investment is more than 10% of your net worth, don't do it. And if you don't feel like you have full transparency and comfortability with the management team or any aspect of that investment, if you don't understand how the cash flows are going to work, if you don't feel like you truly have an in-depth industry understanding of rental properties and a, like some kind of knowledge of real estate beyond an average layperson, don't do it.
Yeah, and I totally agree. And this is one unique area where me and I differ on kind of our investments. Is I do invest in real estate. I have a couple of properties I rent, and I think knowing your strengths and weaknesses is really important, especially in finances and planning your investments. But really in all things. I mean, to put in perspective, I just spent a couple $1,000s on an AC repair in one house, and yesterday I was pulling weeds in 100-degree heat, and asked myself, is an Airbnb really worth keep going? I could just put that money in an index fund instead and be in the air conditioning and just sit and watch. So there's plenty of people that do really well in real estate, but there's plenty of people that have lost everything in real estate. So I think making sure you fully understand the ins and outs, and that, like Mia said, that you accept that risk that you could lose the entire investment, not just some of it, like if you invested in a large cap company in stocks. I think there's
When
another real.
someone receives a settlement, does the client have to use the financial advisor that is referred to, or is the best the client shop around? What and then what ought one look for as red flags as it relates to financial advisors? So I'll answer the red flags, and do you have to use the investment advisor for the settlement? I'm going to kick that to Nate as a lawyer. So red flags for financial advisors. It is illegal according to our license requirements to guarantee returns. So, meaning my company takes our like 0.5% or 0.65% fee, whether we make you money or lose you money, because it is illegal. Fully illegal, no exceptions as a financial advisor to guarantee returns. So if someone's like, hey, I can assure you you're going to make 10% on this investment, 20%, 5%, um, that we can't do that. So that's illegal. Other red flags, somebody who's not licensed, somebody who doesn't have the adequate experience, right? So it's like someone could have taken the same test that I took and have a license, but they've never worked in finance. They have no experience investing. So to me, those are probably the top red flags that jump out to me.
Yeah, I think one of mine, and something I always ask whenever a financial advisor pitches me a network event or a friend of a friend, is I ask them to explain to me what their own investments are.
That's a
Just
good
like how
one.
Mia talked about, what she invests in, I've talked about what I invest in. If someone's wanting to take your money and manage it for you, but they're not willing to show you where they put their own money, that's a red flag to me. I don't necessarily need them to have more money than me or to have a complex investment strategy, but I want to see, okay, if you're so good at what you do, how much are you in debt? Do you have investments in the Bitcoin that you're trying to sell me in really aggressively? And does it contradict the advice you're giving? Are they taking their own advice? I think is what it kind of sums down to. As far as the settlement part, I'm assuming you're talking about maybe a settlement from a lawsuit or like a workman's comp claim, car injury, that kind of thing. Um, you shouldn't be getting referred immediately to a financial advisor from any court or anything like that. So if you're being referred, my guess is it's from the attorney that got you the settlement, in which case I recommend shopping around for the same reason that doctors don't necessarily make great investors. Attorneys don't either. So just because the
Nate
attorney,
doesn't do the investing, I do.
yeah, and I'm the exception. I'm the nerd of the attorneys too. So I give them a headache with my nerdy talk of finances. But yeah, I shop around. It's important to both find a investment advisor that their fees you're comfortable with, that their knowledge base you're comfortable with, but also that you just get along with. This is going to be someone that hopefully you're maintaining a professional relationship with for quite a long time. So you want to make sure it's a good fit for you. And I know we're running close, Leia, so just give us the boot when you got to give us the boot.